Hello, welcome to CRUX Investor. We caught up earlier today with Brendan Yurik, who is the CEO at Electric Royalties, TSXV listed royalty company. One of the newer entrants on the block, been around for just under a year, focused on battery metals and also imminently about to close their first cash flowing royalty. So we talked to him about how he's going to finance that, what it can mean for the company, and of course, the other 12 royalties that they have at hand. If you want our thoughts and opinions on that conversation, the company, the royalties, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. There's commentary from experts from around the world on a variety of companies and commodities and topics like royalties. So do check it out. Very, very insightful. We do training courses to help you with your own diligence process. We do summaries of all the interviews that we do just to save you some time because we know you're busy. And if you want to join a thriving community of investors sharing their thoughts and ideas with each other in a nice, friendly and safe environment free from judgment, trolling and abuse, go and join them at cruxinvestor.com/club. I think you'll really like it. And do give us a like, it'd be appreciated. Leave your thoughts below. We'll get back to absolutely everyone. If you want to see precisely what we talked about with Brendan today, take a look in the description below. Brendan, how are you doing, sir?
I'm doing well, thank you. How are you doing today, Matt?
All good in the hood. Where in the world are you?
I am in beautiful Vancouver. It's pretty sunny out today. It's actually a nice day, so life is good right now.
Should make it a quick one then. So you can get out there.
No, I'm excited to chat with you. Thanks for having me on.
Cool. Good, man. Well, look, hey, we've not spoken or met before, and we've not heard the story before, so I'm really intrigued. But I always ask people to start with a 1-minute overview of the business, people who like me haven't heard it, and then I'll pick up with some questions, okay?
Yeah, sure. So we are a new mining royalty company. We are the only royalty company out there right now focused exclusively on the entire suite of battery metals. So that includes zinc, tin, lithium, cobalt, nickel, copper, vanadium, manganese, and graphite. We've got 12 royalties already acquired to date since going public in last July. And we actually just announced our first cash flowing royalty acquisition about a week ago. So we're excited about that. We're just kind of getting going. We've got a really good management team put together. Past experience building out royalty companies, but really just kind of getting started and, excited to show people what we're going to do here moving forward.
Okay. So you're what, about a year old?
Yeah, about a year old. Yeah.
Right.
We went public in the middle of COVID. Yeah. Yes, exactly. Yes. Yeah, no, that was a fun experience, but, we managed to oversubscribe our initial financing and, closed out all the royalties we had signed up prior to going public, within about a month. So, it was a fury, of timing, but we're excited that we got it done, and here we are now moving forward.
Fantastic. Okay, so how much did you raise when you listed?
We raised 5.2 million.
And raised anything since?
We haven't raised any capital since. No, not yet today, but we will be doing something here in the near future.
Okay, fine, fantastic. Okay, well, you said you've got a track record in the royalty space, so. Who on the team has transacted royalties before? Yeah,
sure. So I guess I'll start with myself. My entire history and background, my career has been focused on alternative financing, project financing, royalty, obviously being a form of alternative financing for the mining sector. I started my career with Endeavour Financial in London. I've worked with a lot of groups in here in Vancouver, including the King and Bay West Management Group, the Hunter Dickinson Group. And I've really been out on my own advising companies, junior mining companies, just like I'd be speaking to now, helping them through this process, helping them structure those deals. And we've also got our chairman, who's also the co-founder and chairman of RE Royalties. They are a renewable energy royalty company. They were really the first group to do it, to be honest. So, it was a good fit in terms of what we're doing, being the first group, going after all of these different battery metals. They've managed to put together about, I'm going to get the number wrong, but I think it's close to 90 royalties over the past 3 years. So that's been very successful. We've also got guys like Bob Schaefer on our board. He was one of the founding directors of International Royalty Corp. Sold on to Royal Gold for, I think it was 700 million. So a very successful deal here, at least locally, everybody knows about it. We've also got a really good wealth of advisors. One of the things that we felt is important, especially when you're navigating so many different commodities and a pretty tricky space, was to go out and get a bunch of advisors, who had experience in this area that we can call upon. So we've got, for example, Greg Bowes as a CEO of Northern Graphite. We have him there as a graphite advisor. I wouldn't want to be in his shoes the past 10 years. It hasn't, been fun. That's starting to finally turn around for them. But, he has 10 years of experience out there. It can help us kind of navigate some of those pitfalls. And so, we also have Richard Williams, CEO of Cornish Metals. He's helping us advise us on tin. We've got guys like Darcy Marood, former senior VP exploration at Yamana, a good friend too, but very smart guy when it comes to that. So we've really built out a team of advisors. We have Rod Cooper, former senior VP technical services at Kinross. We've got Marceau Schlumberger and his father Nick Schlumberger. A lot of obviously oil experience from the family side of things, but private equity experience, family office experience. And really kind of tracking down the technologies that are coming out, what's next, which is always good to kind of keep an eye on. And so we've really got a wealth of knowledge and people that we can call upon.
Right. So what I'm hearing is you've got a lot of advisors on terms of to be able to assess projects technically, right? One guy that's done royalties before, and that's the rub here is, how involved is he with your company? Is he helping you construct these royalty agreements?
He definitely helps structure these agreements. I mean, we have a pretty good legal team as well, but we like to do as much in-house as we can to keep expenses lower. He does definitely helps me, draft a lot of those agreements as well. I mean, he's seen, he's a little bit older than I am, which is good to have, a little bit more experience over time. You see a lot of different agreements. But we've also got a really good team at McCarthy, Tetra. And, they've been responsible for a lot of the real big streaming transactions you've seen in the space. I believe they did, help Glencore on some of their stuff in terms of base core. And, they were behind the Nemaska lithium deal and stuff like that. So, we really got a good team built to do much larger deals.
Okay, but you're not there yet. So let's talk about your portfolio. Okay, you've got one cash flowing royalty. Tell us about that.
Yeah, sure. So that's it's on the Middle Tennessee zinc mine, owned and operated by Trafigura, and they've just taken over. Basically, those assets were restructuring of Nearstar, happened at the end of 2019. But first class operator. If you look at what they've done with the Matza mine in Spain, as soon as they acquired it, they basically went on a campaign investment, plan to double production. And so where Trafigura goes with this in terms of capital spending and growing the asset, remains to be seen, but it's already producing, it's produced intermittently over 50 years. Now you think, well, that's a pretty long time, already produced over 2.7 billion pounds of zinc to date. And if you go through that operating history, you see, pretty consistent recoveries. The deposit has been pretty consistent and it produces a really clean concentrate. So right now, since production restarted in 2017, middle of 2017, it's already paid out royalty revenues of close to 5 million. And we really see some upside in a couple different areas. We see Trafigura coming in, nameplate capacity is 50,000 tons of zinc a year. They were kind of only hitting about 40,000 tons, a little bit undercapitalized, I think, with the previous operator. So that's about 20% upside. And we really see zinc pricing upside as well. Copper gets a lot of attention these days, but zinc, I think, is going to be an important, player in the energy storage space, the renewable energy space, whether it be, from galvanizing, steel, the wind blades for wind turbines, and also, but infrastructure too, right? If you look at, bridges, there's a lot of zinc that you need to galvanize steel, keep it from corrosion. And so, Glencore actually came out a couple weeks ago, and they have a great little chart that's in our presentation. And it basically shows that on a relative basis, zinc demand is actually going to outstrip copper demand in terms of growth profile over the next kind of 20, 30 years. So it doesn't get as much attention maybe, but, we are bullish on zinc and where things could go there.
Well, it's had a tricky ride the last 3 years, and came back at the end of last year. But let's assume they can sell all of it. Let's assume that the throughput is 50,000 tons, right? What's the contribution to your bottom line? Because given that's your only cash flowing royalty, I just want to understand what the contribution is.
Yeah, so at today's zinc price, assuming that they can, ramp this up effectively and get over some of the COVID delays from last year, we'd be looking at about $2.5 million a year in royalty revenue. Based off our calculations, they've got about 15 years of resources outlined. So, estimate kind of a 15-year mine life to date. But really, we see a lot of expansion potential beyond that. It's kind of thing, has been producing intermittently over 50 years. So they never drilled it out, to this point in time. At that point in time, it's just a capital spending decision. But these types of deposits tend to be very, very large. And so, we think this is going to keep on going. And you got to remember, this is not just a single mine. This is a mine complex, right? There's, 3 underground mines. There's a exploration project on site. And it's really vertically integrated with a smelter nearby, the Clarksville smelter. That is the only primary zinc producer in the US. And, because of the way the business is, right, with trading groups, and especially with a trading group being the owner, the smelting operations and the trading operations far outweigh and dwarf what they're making in mining profits. And with the really clean concentrate at the Middle Tennessee zinc mine, it's really kind of key to that smelting operation. And so, there's always going to be an impetus to keep this thing going, even if it was losing money on the mining side. Not that it is, but it's kind of nice to have that little bit of security in there.
Right. And you're telling me the cash flow, therefore, is sustainable as far as you're concerned at $2.5 million to you each year going forward.
Yeah, that's the hope. I mean, right now, if you look at it, and last year was a tough year, for everybody with COVID delays. All prices of commodities dropped there at the beginning of last year, which has obviously changed since then. Copper's had a pretty good run. Zinc's had an okay run. I think it's got some ways to go. But right now they're paying out about $110,000 a month for January, February. But yeah, we're hoping as they ramp up production and hit that nameplate capacity, that we'll get to that $2.5 million number, hopefully by the end of the year.
So was that the total number of cash that you had to date?
So this year to date, in January, it paid $110,000. And in February, it paid pretty much $110,000. So it's on track right now for about $1.2 million this year. But they are still, kind of getting over a little bit of the COVID stuff from last year, ramping up production. And so we're hoping that will increase here by the end of the year to our annualized number.
Okay, good. How much did you pay for that?
So the acquisition price is $13 million cash and 14.5 million shares of Electric Royalties. We've had, a little bit of feedback that people say that's expensive, and they look at, maybe the payback period, being a little bit longer than you'd see in some other investments. But you got to remember, this costs us nothing to hold after this, right? We have no cost going out the door. All the exploration upside, after that payback happens, it's just cash flow coming in, and that cash flow could be coming in for another 10, 15 years beyond that. And again, it costs us nothing to hold that. So, people have to realize that you might have a longer payback, but, you've got to look at this as a much longer term play. If someone comes to you and say, hey, I could give you $10 million today, you're going to pay me back $1 million every year for the next, 35 years, people might think that, that's kind of how you have to think about it. Right. So we're excited about it. It's a, relatively, good jurisdiction, good operator, still has a good mine life, good operating history. Putting something into production is always a tricky business, right? You got to think about how much de-risk this is relative to, some earlier stage projects that you might be looking at.
So just help me, because I'm a bit confused. You told me you raised 5.2 million at IPO, you haven't raised any more cash. So you've got some kind of facility in place to pay for that, yeah?
We don't, as of this moment.
Right.
We are currently kind of gauging our financing options. We have 3 months runway. So we signed this deal just basically last week. We've got 3 months to close it. We were pretty careful about making sure that we left ourselves open in terms of how we can finance this, how we can pay this. So, I don't know how many people actually caught it, but we have in there that we can bring in a co-investor, for example. So that could really take away, a good chunk of the cash portion of the acquisition cost. And typically I wouldn't want to do a co-investment, at this stage. Like, we really like the royalty, but, part of our, theme has always been diversification, and so I can understand this is a lot of eggs to throw in one basket, at this point in time, given our relative size. So, that's something we're considering and looking at. Debt financing is not necessarily off the table. Convertible debt has been used pretty effectively in our space recently. If you look at Nova Royalties, for example, that's a good example of how that's worked out well. Then we're having some discussions with bankers and such right now. So we're hoping to formalize a financing plan, in the next few weeks to basically answer your question about how are we going to finance this.
Right. Okay. And so how have you then collected revenue in January and February?
So when I said that was the royalty revenue that the current operator or current royalty owner has received.
Got it. Okay, so at the point
so I was just trying to give you
give me an idea. So I want the real number. So at the point you do the transaction, you become the royalty owner. You will be, you think, picking up something like that per month going forward. So the rest of this year, let's say you transact in July, you got 6 months at that. Right. Okay, got it. Understood.
Yeah.
So that's really interesting. So it's not cash flowing yet. What are the barriers to you being able to get that across line? Getting finance at an appropriate rate, or being able to raise capital by diluting current shareholders? I mean, what are the options that you're thinking about?
Yeah, I think there's quite a bit of money out there right now, to be honest with you. So I see some of the other groups, some of the other deals out there. We've had quite a bit of interest already. I'm not, extremely concerned about that. The market can change in a minute, so you don't want to necessarily wait forever. But we're just kind of looking at those options. We want to do what's best for shareholders. Myself and my family are combined the single largest shareholder in the family, or in the company. So, we just want to make sure that we pick the right solution for it. But we definitely plan to close this transaction. I think 95% of mining companies never achieve cash flow, and this gets us there. And if you look at the multiples of where base metal royalty groups are trading, and we don't really have any better comps because we're the only battery metals focused group, but those have gone up considerably over the last 6 months. To the point where you're almost seeing a parity actually with gold royalty companies, which is interesting. So if you look at it from that kind of metric, and if we can hit that 2.5 million annualized cash flow number, the transaction could be valued at, $40-45 million, in our company today. And I actually see those multiples continuing to increase, as we move forward here. And as more money and investor awareness kind of gets out there in terms of the real issue with all these metals, I think it's probably the biggest risk to the EV revolution, is going to be supply. And that's what we looked at, right? When we got this going, we looked at the supply side, really picked out which projects we thought, could actually fill that gap. And it doesn't really matter. Even if all of them come online, you're not going to fill that gap, And so it's pretty obvious for us. It takes 15 years from, drill hole to you might be able to bring it into production. There's no way to overcome that gap. So we see higher pricing across all these metals kind of coming here in the near future.
But it's also attracting a lot of people, right? So there's a lot of new royalty companies. There's some even younger than you, right? You've been going a year, and then we've interviewed two or three who are younger than you. But you're all after the same thing. The people are excited about royalty companies again. A lot of small royalty companies are here. So there's this kind of the royalty bandwagon is off and running. But you're all saying the same thing. So it's really hard for us poor investors to try and work out who's who at the zoo. So cash flowing is obviously a buzzword and a phrase. And if you can get that going, it's a good start. What about your other 12 royalties? What sort of shape are they in?
Yeah, so we've actually got some really exciting development royalties. And maybe I'll just kind of answer your first question. There has been a lot of new entrants. And I think everybody, I don't know how I could ever, go back to repping a, single asset, mining company after being a royalty company. It's just, it's got so many advantages. So I don't blame everybody. I would say that the difference from us is really focus, commodities focus. All the big established players are primarily gold and silver, precious metals. Most of the new entrants have made that their focus as well. And, that's a lot of competition, across a couple commodities. So that impacts pricing, your ability to build a portfolio and to grow that portfolio. And like it's kind of like an internal rule for myself, but I think the only real risk of a royalty company is that you don't hit capacity or a certain size. If you can't build a royalty portfolio to the point where you're a royalty company, and that's kind of where I figured it'd be very tough to do in the precious metal space. Whereas for us, I mean, some of these commodities, we're the only group out there that these groups can come to. So, we've been getting a lot of inbound deal flow. And if you look at, graphite royalties or tin royalties, manganese royalties, there's a lot of these commodities that there's only one group kind of out there right now. So that means pricing is generally much better, and our ability to access deal flow is going to be much better. So that's kind of just that. So in terms of our portfolio, we've got a flagship lithium royalty, the Oche lithium royalty in Quebec, owned and operated by Sayona Mining. Now, they actually just got a strategic investment from Piedmont Lithium for, I think it was $12.5 million. They also have a project level investment. They're in the middle of acquiring the Canada Lithium mine right next door. That would expedite production basically on our royalty kind of 12 to 18 months out. So we're excited about that. It's one of those situations where the Canada Lithium mine really needs to blend the ore from another project, and this project happens to be right next door, feasibility stage, kind of ready to go. So that's kind of our flagship lithium royalty. We also have some area royalties.
I'm really trying to understand how you set these things out. Okay, so let's take that one because it's the first one you mentioned, right? So why not? You've got a royalty over 100% of that land package.
Yeah, so that royalty covers, this was an existing royalty that we acquired. So all of our new royalties, they cover the entire land package. Right. This covers about 65, 70% of the deposit.
Right.
But we also have much larger royalties on the exploration claims around it.
Right.
And so.
But they're further out. They're further out, right? So,
yeah, further around. So you'd have the deposit, right, in the kind of main heart of it. I'm trying to put up my hands, and then you have the exploration packages around it. And a lot of these projects, whether it be in Ontario or in Quebec, they tend to be kind of regional. There is a lot of regional potential. So we have much larger royalties on the exploration package. And ultimately, my kind of thinking on how lithium goes here is that you're going to have these central lithium processing hubs. Whether it be at the Canada Lithium mine, whether they have one in in Ontario that comes up, where you have a lot of different projects end up kind of combining on the same team, as it were. The processing facility seems to be the big risk, and so why everybody go out and try and build one to see if it works? Why don't you pool one and have all these resources kind of come together? So, we've got some other royalties in and around there, in and around the Canada Lithium mine. Great Thunder Gold is actually drilling one of them right now, or planning to. They just released updated NI 43-101. And we just picked up actually last February our first one in the Ontario camp. So that's the Seymour Lake royalty. Sandstorm owns the other half of it. And it's, going to be one of those things where it's probably going to be part of a number of other projects that ultimately, form a new hub in Ontario.
Cool. I'm trying to maybe ask a question a different way. I'm trying to work out which projects or royalties are significantly advanced. Because as you say, some of these things will take 15 years to get into production, 15 years to your cash flow for you, right? So, and we've talked about the cash flowing one. So of the 12, can you kind of break it down for me and say which ones are most significantly advanced? Which ones have, 43-101, or I assume it's all North American, resource number, which ones are drilling, which, et cetera. That'd be a really good sense of how close you are.
Yeah, sure.
Okay.
Sure. Yeah. So, okay. I'll just go through it real quick, just kind of list version. So the Oche project, operated by Sayona Mining, that's feasibility stage, ready to go. The Seymour Lake project, it's got a resource on it. It's JORC, so it's Australian, but it looks, pretty identical to where Oche was just a few years ago. We have our manganese royalty on Battery Hill. They're putting a PEA out, fairly shortly here, over the next couple of months. But the metallurgy is very advanced on this. There's a pretty good comp next door, so we can kind of, extrapolate what it's going to be. It's going to be our biggest royalty in terms of potential cash flow a year. We're looking at it being kind of $6 million a year for, 35, 40 years. So, we're excited about that. It's the only manganese district in North America, developing a project for manganese to the EV space. We also have a graphite royalty this is feasibility stage, ready to go. I mean, all permits, everything. They need an offtake agreement, and they're off to the races. Construction time, I think, is 18 months. So within a couple of years, that could be in production. And then we've got a vanadium royalty on Vanadium 1 Iron Ore Corp's Mont Saucier project. Huge project, 38 years mine life. Fantastic economics, could be the best, iron ore development project in North America. And that project alone, we're expecting cash flow to be about $1.5 million a year. Our royalty there only covers vanadium, but it's it's still $1.5 million a year for 38 plus years. They're actually in the middle of putting out an updated resource in the near term as well. So a lot of work going on those projects. Those would probably be our kind of core ones if I had to summarize it up.
So in the next 2 years, apart from the cash flowing asset you're talking about with the zinc, there's no cash flow from those. So you're building up there's a development portfolio there, it seems. Is that be fair to say?
Yeah, I mean, there's a chance that the Oche royalty, Oche lithium royalty, and the Graphite Bissett Creek royalty do pay within 2 years. But yes, that is correct.
Okay, fine.
Not to say that we're gonna be standing still in the meantime, but yes.
No, of course not. So, but again, I just want to get people to build a picture of the type of business model that you are going to employ. And how you blend the different phases, exploration, development, production companies into that. So you've got 5.2 at the moment. You're going to look at financing somehow for the acquisition of the cash flowing zinc business. Royalty rather. You're going to need more money or a facility or two in place as well. So how do you go about addressing that?
Yeah, and I would say, first off, if you look at our acquisitions today, we actually are paying a lot of our acquisition costs in shares. So our Seymour Lake acquisition very cost us no cash. So there's always opportunities like that out there. But no, I mean, look, we are looking at creating new royalties right now. We are really focused on cash flowing royalties. We were trying to build up a number of these, 3 or 4 of them, to really have a base that we can go out and acquire new royalties without dilution moving forward. And so, those kind of take time, and we're planning on financing those a little bit on a transaction basis at the moment. It's just kind of easy in this market, I guess, or it's kind of the way to go. But that's what we're looking at doing. We would like to keep dilution to a minimum, and so hopefully we can plan these out. So it's you get one done, you close it, you get a bit of a re-rating, and you build it out that way. We don't want to try and take on too much debt, too early on. I think we have no debt right now, and I love it. I'm not stressed out. It costs nothing to hold these things, so money is being spent on these all the time by our partners. I think our partners raised about 20 million last year. To basically move and develop these projects along. That cost us nothing. It didn't dilute us at all, and just really increased the value. So, we see this, probably more equity, but like I said, we are looking at convertible debt. We've had offers from a lot of groups on co-investment. So we'll kind of see. I can't say too much, obviously, because we're kind of working on that right now, but I hope people are, pleased when they see what we put together on that front.
Why don't companies go and create their own royalties on their own assets? Wouldn't that be easy for them to do?
Yeah, they do that. They have done that. You've seen a few of those, actually. So Gold Royalty Corp, they did that just not so long ago. Empress did that as well, actually, with some of their exploration portfolio. So
Great Bear.
It seems like cheating to me a little bit, but I can't say I haven't approached other groups about similar type transactions. That's not something that we're necessarily planning on doing. I think if you look at the space and the new entrants, I would say most of these groups out there are just consolidating existing royalties. So there's no new royalties really entering creation, as it were. They're all fighting over the same ones, and it's really tough. Pricing is really expensive because you're not taking advantage of a moment in time where a group might need money, or there's a circumstance to it that would see you get a better deal, right? Whereas we are really looking about 50% of our time is spent on creating new royalties, and so that's where we look at we pick out an operation that we want to be part of. And we go in and we say, all right, we pick our time. Okay, they might need a bit of working capital. we go in, say, we'll fill that need. A royalty can fit around any kind of financing. You can have it around debt, you can have it around equity. It's not going to, prevent you from using those avenues. So we're a real, kind of ad hoc solution, or, as they need it. And so that's kind of where we're kind of focused right now. I will say we get some great incoming royalties that are existing royalties that groups want to sell. So, I would say all my focus is really on new royalties, but we get so many inbound coming on existing royalties that, it's an easy business decision to say, yeah, well, I would love this. Let's go ahead, push ahead.
But you don't want to overpay. And there's a lot of competition, a lot of juniors, royalty companies, all just trying to get a position, build a size, get noticed. So you will pay a lot of money, and that hurts you down the line, doesn't it?
Well, yeah, I mean, look, I think if you look at our acquisition cost today, and our latest one, it's a cash flowing existing royalty. It's got everything there. So you're going to pay up a little bit, you're going to pay for quality, but our acquisition costs on our previous portfolio and the rest of our royalties combined is about 0.05 times MPV, which is about 1/20th of what they're paying, in the precious metal sector. So, we do like to do some cheap royalties, but at the same time, there's certain assets out there you just can't recreate, and it's not only some of the new entrants, there's private equity groups too, that pick away at these things and have, very deep pockets. So you do have to kind of pay up for good quality, as it were, but, over the long term, I think this transaction is going to look, I think if you look back at this 2 decades later, and if we're still making $2.5 million a year, it's going to look like a good deal.
It will, but you need to build on that. You need to show your, sustained cash contribution, and it's got to build over that time too, because that's the only way your shares are going to, see the benefit of that. So me as an investor, I'm looking for you to demonstrate to me that you've got near-term cash flows, that you've got the blend of companies right, that you're not overpaying all of the time, because that's what small royalty companies need to do initially, or feel they need to do, right? So how do you stand out from the rest? How do you do that?
Yeah, so, well, and I wouldn't say this necessarily makes us stand out, although you don't really see too many other groups focused a little bit earlier down the timeline as we are. And that's really how you focus it out. So if you're looking at an exploration stage property, they've got a nice resource, and you're going in, but you can say, okay, like, for manganese, it's really simple, right? It's like there's one district in North America, looking to be the supplier of manganese for the battery space. So it's different for these commodities. And that's the funny thing, we're a little bit of first mover, because we've already looked at the manganese supply pipeline, we've looked at the graphite pipeline, we've looked at the tin supply pipeline. And if you look at it, it's not going to be the same as it was, or it is for gold, for example. There's only certain land packages, only certain projects, only certain resources, that are 5, 10 years, 15 years down the development timeline. And so, we move a little bit further down that timeline, but the cost of acquisition as you go down is much, much lower. And so, you're going to have a blend of these ones where you're getting in at the resource stage, and you're going to see this incredible growth in value, over time as it gets to production. But, we felt it's also really prudent to have, a few cash flowing assets that are kind of, they're going to be there to fund you, if markets dry up, for example, or, and so it's a bit of a combination of those. And by going a little bit earlier down on some royalties, you get that, you can keep that multiple very high for return on investment.
Well, it certainly initially funds your G&A, your salaries, your overheads, all of that kind of good stuff. So that's good news, because you don't have to go out and raise dilutory money off that. But you are going to have to show the market your ability to get cash, get cheap cash in whatever form that is, and then tell them what you're going to do with it. And I think that's the challenge for companies like yourselves. Okay, you need to be really clear about what is your differentiator in terms of finding projects. You're saying to me, manganese, no one's really interested in it. We're a market of one. Graphite, the same, right? So you're saying, right, but that's today. I mean, you mentioned,
and that's changing,
and that's changing, right? That's changing. We've spoken to a handful of people who are going to be starting royalty companies. They contact us, say we're going to be starting battery metal themed royalty companies. So it's coming. So the competition is coming, and they're going to have different levels of access and track record and all of that kind of good stuff. So first mover advantage doesn't always last that long. So I'm just intrigued as to how you plan to go about building this company. What do you see that's different, or are you just repeating what's gone before? Because it kind of works.
Yeah, well, look, yeah, I mean, you don't want to break something, that works as well as it has, obviously in the precious metal space. But yeah, no, look, I mean, we have to be a bit more dynamic. It's just a bit different game. And so, we are looking at, branching out. I mean, at the end of the day, we're almost supporting the supply chain, for electric vehicles, batteries, etc. I think this is going to be a shift you haven't seen before in human history, where you have so many new sets of demand, basically legislated by government and funded by government, for the drive to clean energy across so many different metals all at once. And so it's going to be, something very new on that side. Where we're going to be looking at, or where we have looked at, some of this stuff will be a bit down the road. But we've looked at recycling as well, as a way of doing royalty financing in that space. We've looked at some of the technologies and actually taking out royalty on the technologies in that space. And these were mostly, it was surprising. We had probably 10 recycling groups reach out to us, within the first 2 months of us going public. So some of these things that are going to change the game a little bit as we were, that would be different. But I think those things are a little bit further down the road. We've been looking at, we looked at a collaboration with an AI group as well, that helps with, basically exploration and finding, projects, battery metals projects. So, something that would help foster the supply growth, further down the pipeline, because it's been very weak. You've had almost no money coming to the sector over the past 10 years. So there's other things like that are maybe a bit kind of out there that we were looking at doing, but it's technologies are changing all the time in this space, right? I think the key thing for us right now, at least, is focused on keeping diversification across all these different metals, so you're not too heavily in one. There's a risk to each commodity out there. You never want to be all in on one commodity. Lithium, I think it's processing technologies, supply disruption risk. There's a lot of interesting things going on, like with E3 Metals in Alberta, in Canada there. So, where you might be able to get lithium out of the old oil wells, right? And you got the clays in Nevada, never been commercially, put into production yet before, but there's a lot of lithium, in Nevada clays. And so, there's different risks in each commodity. I don't want to be overweight in any one. I think that's kind of important. And even the groups that are, coming in, there are a couple of groups looking at manganese, but they're still not looking at tin, graphite, zinc. And so, rather than trying to predict where these, technologies are going to go, battery chemistry is going to grow, we feel like it's important to be, diversified across all these different metals.
Right. I get the theory. I want to focus on is you. I want you to tell me how you're going to make me money. Right. That's what I want to hear from you. Okay. So
yeah.
What I'm hearing is we're going to be niche. We're going to try and be niche because no one wants to play there. It's too small. Is that it?
It's niche for now. Yeah. And that's the plan right now. I think if you look around, right, there's maybe 20 development projects out there, maybe a little bit more for lithium globally, right? Of those, you've got, maybe 8 in Argentina. Okay. So then you've got, a few in Nevada, you've got some hard rock guys in Canada, but in jurisdictions that we're chasing, because we think end users, battery guys are going to want to have a domestic source of supply. Elon Musk has come out and said it a few times for multiple reasons, right? I mean, initially for, security of supply, so, there's not going to be a government overthrown and there goes your mine or supply. And also, if the whole goal of this is to reduce carbon emissions, you don't want to be sourcing your ore from Indonesia when you have a plant in Ohio, because that just kind of defeats the purpose. And when you look at those projects in these jurisdictions, there's only so many, and that are advanced and far down the pipeline. So we're really trying to get out there and scramble and get royalties on those key projects that are going to be that next source of supply. And so, there are other groups that might be coming in the space. We're 2 years ahead of them. We've already kind of identified this and for all these different commodities. And we're just trying to go out there and scoop up royalties on all these different projects. And I don't think it's a short maybe advantage that we have in terms of getting out there. But it is a tricky sector. Groups are going to struggle to catch up to this. There's not many other royalty companies out there that are targeting this many metals. They're mostly one or two metals. And we've already done our homework on all of them. But there's not that many projects out there. So, we've already got, right, 2 of the 3 resources in the only district in North America for manganese. We've got a couple royalties for hard rock in Eastern Canada already. There's maybe, a few others that we want to go grab. So, there's only so many in each area right now that we really feel are key strategic, and we have nobody, kind of competing with us at this moment.
Brendan, nice run through. Appreciate you spending your time with us today and sort of talking through this. I'm going to call it a new company. I know you're not new, but it feels new. Stay in touch. Let us know how you get on as these things kind of develop. I'm particularly intrigued by your financing, how you go about financing the business and the acquisition. And when you've done that, please give us a call, okay?
That sounds great, Matt. No, I appreciate you having me on, and I might be calling you sooner rather than later.